Myth number 5, taking a loan against your cash value is the worst thing you can do. You're borrowing money made up of your own deposits. Well, guess what? When you go to the bank and you ask for a car loan or a home loan, you're also borrowing money made up of your own deposits. Because, I mean, I'd much rather borrow for myself and pay myself back at interest than pay a banker that I've never met. Well, I used to coach for Robert Kiyosaki. I was one of the Rich Dad Poor Dad coaches for a number of years. And I've read many of the books like these, Tony Robbins' Money Masters, where he goes in and interviews some of the most wealthy and smartest money people out there. Some of the concepts that all of these types of books have in common is what's called other people's money, or as they call it, OPM, which talk about leverage and then a positive spread. So I want to ask a hypothetical. If your bank paid 6% interest on savings, and I know that's crazy, right? Because they pay less than 1%. But let's assume that you could deposit your paycheck into your bank and your bank would give you 6% interest on your savings. And then you could borrow that money back at 4%. I know, completely inverted, but follow with me here. If your bank would give you 6% savings and you could borrow back at 4%, the question then would be, what would you do to buy big ticket items, right? Would you use OPM or borrowing other people's money? I mean, this is the amount you're paying on the borrowed part, and this is how much your savings is making. Would it make sense to drag any of your money out of savings, or would you always borrow? Of course, we would always borrow, but a bank can't do that. When borrowing against your cash value is good, and there's 3 different things that I thought of today. 1, to snowball my debts. Remember, we just talked about that. So you can snowball your debts, but I said they're on steroids. And the reason I say they're on steroids is that you still have your cash value in your insurance policy, and it is continuing to grow at a guaranteed, yes, I use that term, a guaranteed compound interest rate. I'll talk about that. The second way is to use your money twice. In other words, first you stick your money into the cash value account, then you borrow that money back to finance other investments. So again, you're getting a guaranteed interest rate with the whole life insurance policy, and you borrow it out, creating this positive spread, and then invest the part that you borrowed in something that can make even more, and then also to supplement your income. So let's talk about the first one, the snowball method. It is much more powerful if your warehouse where you store your money can provide a positive spread with guaranteed compound interest. Let me show you how. Now, I, like the gurus, don't advocate getting into debt, but there are times, like improving your lifestyle, that it makes sense. So believe it or not, at age 54, I went back to college to get a third master's degree, and this time in data analytics. And since my company was paying part of it, but not all of it, I borrowed $10,339 from the Department of Educational Loan Services, or whatever they were. And my interest rate is 6.6%, right? So, again, looking at my cash value insurance policy, I've only had for 6 months, has a cash value of $15,000, and I've already borrowed $9,851 of that. So I still have a net cash value of $5,964. Okay, so educational financial. I'm paying 6% on $10,399. In other words, if this was a snapshot in time, obviously I would continue to pay down on this on a monthly basis. But as a snapshot in time, my interest on this loan from the Educational Financial Department is $686. But with the insurance company, I'm capable of borrowing at 4.76. So that same $10,399 is going to cost me $495 in interest. That alone would be reason enough to pay off a higher interest rate loan with a lower interest rate loan. And here, as you can see, I save $191. But it isn't over there. Remember, I still have this $15,816 in cash value. And my cash value account is still growing for me at a guaranteed 4% compound interest. So when you multiply $15,816 times the 4% compounded interest that I'm getting, I'm going to earn $633 on my compound interest. But again, remember, I'm still paying this. So when you subtract the $495 that I paid the insurance company in interest for borrowing this sum, $10,399, versus how much I'm making with my cash value, you come up with, again, that positive spread of 138. My snowball savings, 191. But I also get my positive spread of 138, which gives me a positive of 329, which is much better than just doing a snowball by itself. That's why I would call this a snowball on steroids. Okay, so thus far we've hit on this fifth myth that taking a loan out against your cash value is not a good idea. And we've shown where at least one place it is a good idea. And that's when we're paying off a higher interest rate with what we can borrow against our cash value and thus create a positive spread. So in other words, the snowball method is fabulous if we have a warehouse that can provide us with a positive spread because it's giving us guaranteed compound interest. Now, I said this a minute ago when I was recording, and Diane came over and said, hey, wait a minute. A lot of people are going to think that if they're paying 4.76% to the insurance company and their mortgage is less than 4.76, that this isn't going to work. You need to explain volume of interest to them. And so I stopped and redid this. Now, this is a pretty busy slide, I admit. This is my own spreadsheet that I use for myself on our home loan. Diane and I had a 30-year note at 4.5% for $245,000 on our home. And as everybody knows right now in 2020, we got this note 2 years ago. In 2020 now, interest rates have dropped. And so we were able to lower this. But let's walk through what the components are in a loan that are seldom talked about. We always hear about the annual percentage rate, 4.5%, right? But the real killer in my mind is this, the volume of interest. And volume of interest has to deal with when interest is paid during the term of the loan, as well as how much as a percentage of each payment is paid in interest. So again, our very first payment on this home when we got it 2 years ago, $1,241 was the monthly payment. Of that, 919 of it went toward interest. That is volume of interest, and that is at 74%. That's why you've got to get rid of all of your interest payments. It's because of this volume of interest. Look at this over time. Again, what we're doing is we're looking at the total payment versus the amount that is going toward interest. And that is in year one, an average. Again, this was the first payment itself, which was 74%. But even so, during the entire first year, we're looking at almost 73% of every payment went toward interest. Now, if we move down, you'll note that 67% of each payment went toward what's called the volume of interest. Year 10, again, our interest is still $738 on average, and our principal is only $504. You're still paying 59% of every single payment is still going toward interest. It isn't until we get out to year 15 that for the first time, the amount that we pay in principal, $630, is greater than the amount we're paying in interest, $611. We finally dropped below 50%.